Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, I love to start these shows with, I've got my notes here from our most recent team meeting. I love to incorporate your insights into the radio show so everybody can benefit from it. And there was a market rally, but you called it window dressing. David, say it ain't so.
Well, imagine that if you could have a way that you sold a product, Chip. Imagine you sell a product and you can change the design of your brochure to look as good as possible every quarter. And say maybe the last 2 or 3 days of each quarter, you decided you wanted to make this thing look just as good as it can do. You would, in downtowns, we call this window dressing, right? You would decorate the stores, right
Fair
before the
enough.
holiday weekend.
Yes.
Well, fund managers do the exact same thing. So what they'll do is they will change the layout of their portfolios by adding stocks that have performed really well sometimes during the recent quarter. So first quarter was a positive quarter for the markets this year. We can all cheer that after going through 2022. But what you see is window dressing is fund managers will add the top performing stocks into the portfolio the last 3 days, rallying those stocks up so that when they print their new materials for the end of the quarter, look at our top 10 holdings. Oh, that was a winner. Oh, these guys must be good. Doesn't mean they owned that level of position or the in position at all for the entire quarter. So it can be misleading. So we call this window dressing, right? And
Fund managers grab a bunch of great looking stocks right before the wire, but the fund didn't get the benefit of those for the whole first
it may
quarter.
or may not have, exactly. We don't know, and
Yeah.
that's just it. You
Okay.
don't know if
All
they,
right.
they owned it at the percentage they owned it, but they'll put it in there just to show you that. And so when people who maybe don't have the expertise to understand how to read prospectuses, look deep into them. In fact, we had a client say you should put a class on recently on how to read a prospectus. Like that's a pretty good idea. So we may add that to our basic education. We have some fundamental things that we love to educate clients on. And speaking of which, man, this classroom has been so full recently with all these different events. I cannot stress how awesome it is to have all these educational events going and how many people are just grateful that we do that in general. But yeah, window dressing is just that. It's just window. It doesn't mean they owned whatever the stock may be and for the entire quarter or it was weighted as heavy as it is at the print. But they have to document at the end of the quarter, Chip, what they have, and that's typically when they're going to print their next what we call fact sheet so that they can put this pretty brochure in front of either an advisor or a client. And let's face it, the commission-based world that sells these things and earns commission on mutual funds, we are not. We are a fiduciary. We do not accept commission on investment security products. Full disclosure, we offer insurance products and certainly get commissions from those if we have to place life insurance or Medicare policies, things like that, because we're licensed to do it. Those are built. But these guys that sell, or gals that sell these investments commission-based, or even what they call the wholesalers that come by the advisor's office. Hey, look at my fund, and they give them these what they call fact sheets, and it's not always factual. Ironic, right? So anyway, so that's window dressing. That's what I was talking about in the team meeting. And you're right. I love to educate our team. We have a team meeting here every Monday morning where I kind of give a couple of brief minutes on what's going on in the economy and the market in general, and often we'll talk about things like this. So yeah.
Well, you also said that OPEC is really putting the squeeze on the United States.
Man, that's easy to see. Holy cow. So you had this current administration, and again, if you like them, hey, that's kudos to you. I'm not a fan. That's been pretty obvious here on the show for a while, right? But we depleted our strategic oil reserves to get the consumers' gas pricing down last year. And if you want to know, it was a political move to help buy an election, if you will, right? Not buy votes, but to help the economy feel a little easier. Your wallet, the gas prices go down, and it helped.
May have stopped a red wave.
Yeah. So, but what it cost us is now we have to fill that strategic oil reserve back up. And this administration, again, not learning how to play chess, barely can play checkers, in my opinion, right? They're telegraphing their moves. So they're telling the world, oh, yeah, when it gets to $70 a barrel, we're going to fill that sucker back up. Well, did it get to $70 a barrel? I don't think so, not recently. And then so the administration asked OPEC to increase production last fall, right after the election. And what did they do? They cut 1 million barrels a day out of production. So now the
Yeah.
price of gas has been rising for everyone. We're at about $3.20 a gallon here in Nebraska as we speak, right? Well, guess what they just did this week? Slapped them again. You know what? Surprise cut on Sunday. We're going to cut 1.6 million more barrels out of production, driving the cost of oil, et cetera, up. Now, I will let you know that Uncle Warren here locally, Mr. Buffett, had just made another major purchase of Occidental Petroleum, one of his largest holdings now, and that benefited. That stock rallied 5% on the news. Maybe somebody knew something. Who knows, right? But anyway, it exactly. OPEC is putting on the squeeze on the American government and, unfortunately, Chip, on the American consumer. And that's my beef with this is it's driving the hardest working people in America that are earning the least amount of wages, minimum wage earners in construction and in wait staff at restaurants, hospitality industry. Those that are just trying to get their feet on the ground in the economic world are going to have to pay the price for this at the pump. And that means more of their weekly paycheck is going to go to put fuel in their car, driving inflation, which we've been fighting for a while now, higher once again.
Well, speaking of the consumer and the basic grassroots American, David, I don't know how to describe it. Is there still a sort of a slow motion run on banks happening? What in your opinion, is
There ain't
the
nothing
mood out
slow
there?
motion about it.
Yeah.
There is definitely a run on banks, and it's accelerating quietly. It may be a quiet run on banks. I don't think slow motion is what I call, but definitely a quiet, because you can do it digitally today, right? You can go on an app and transfer money. We've got clients calling. I mean, I had clients move over 7 figures from a bank account this week. Explained to him how the FDIC insured works, and he just wanted it something safer. So we're using treasury management, just buying short-term treasuries. But this is something we're seeing a lot of people do, is get fearful of the banks. So we want people to calm down. Again, no one's ever lost a dollar in an FDIC insured deposit that was under the limits. It used to be 100 grand, now it's 250, and certainly talk in Congress and what have you to raise those limits. Again, that comes at a cost. There's insurance involved, and who's going to pay for it? You and I, again, as the consumer. So, but yes, there is a run on banks, and the carnage is not finished yet. In fact, Jamie Dimon was just quoted on one of the financial talk shows this week, is saying you're going to see significant fallout continue to fall. Now, he kind of likes that, if you want to know my humble opinion, because he's one of the benefactors. The 4 big banks that are over $3 trillion or so in assets each, Wells Fargo, JP Morgan Chase, Bank of America, and Citigroup, they benefit, right? Because they're the ones gathering deposits, because people think that they're the safest banks. And of course, under Dodd-Frank, which we talked about exclusively in the last or extensively in the last couple of weeks, right? They're too big to fail, so they're not going to be allowed to fail. So that's why people are clamoring there. I will tell you, make sure you understand your banking relationships. If you have fear about it, we want you to calm down. Banks are not going to fail, and for most Americans, they're going to be fine operating in any bank here in the U.S. But we're happy to have a conversation with you if you're nervous about that stuff and understand how it really works.
Well, David, as we tell people often, we also monitor political events here because they certainly affect economic events. You sent me a story from NBC News about that Chinese spy balloon that flew over us, among other places. Chinese spy balloon gathered intelligence from sensitive U.S. military sites despite U.S. efforts to block it. Why does something like that show up on your radar screen, David?
Well, I mean, this is just how bad our national security is being protected or not being protected, in my humble opinion, is and there's multiple of these balloons, right? So now we're getting evidence that they've been doing this for a while, and nobody was kind of reporting on it. It didn't get out to the media, but they've been collecting data. These balloons were controlled, right? They're doing figure 8 patterns. All this has now come out in the article. It's showing you there, and they were collecting sensitive data from mainly our military institutions. And right here in Omaha, folks, we have Strategic Air Command. We have some pretty important data here that could have been compromised because it's on radio frequencies, and they're picking up and interpreting those. We don't know the extent of that at this point, but I think years from now we will find out more, as we always do. But it's bad news, and the administration just keeps acting like it's a nothing burger. And I think it's a incredibly important story that we'll have to do some more follow up. But it's going to have ramifications because the geopolitical world we're in and the tensions around the globe are getting hotter, not cooler at the moment.
David, let's bring it back home. I'm going to throw you a couple of headlines here related to labor and the workforce. The first one's from CNBC. McDonald's closes corporate offices as it lays off hundreds of workers. I was a little confused by this. It's it's a temporary closure, I guess, of the corporate office. So, what's really going on there, David?
Well, you remember we talked about remote workers, they would be the
Yes.
first to get fired, unfortunately,
Yes.
because out of sight, out of mind. Well, the folks at McDonald's, they don't have the heart to come up and tell you, Chip, we're no longer need your service. We're going to let you go. We've shut down the office for a couple of weeks, and we're going to notify those of you who aren't going to be employed to come back virtually here short. So they're going to send out
Wow.
virtual messages
Okay.
in about 10 days to these employees that are going to be sent packing. And again, it's another major corporation announcing major layoffs, and they're cutting high salary jobs. The corporate, this is not the minimum wage person working in the restaurant. They've already made those cuts because of the increase in minimum wages in so many cities around the country. It's now all kiosks, right? There's so few employees actually in a McDonald's anymore compared to what there were, a few years back. But now they're having to cut the white collar staff, so to speak, at the corporate offices, and they didn't have the the wherewithal to just do it face to face. I mean, if you've seen, there's a movie, George Clooney movie, was Up in the Air, where they hire somebody to come in and do this type of things.
Uh,
They didn't even want to do that. They just, no, we shut the office down temporarily, but watch your email, Chip.
yeah.
You
Yeah.
might not want to be checking that email or
Well,
text
that's
message.
that's chilling. So is this chilling from the Wall Street Journal. The headline is "The Class of 2023," talking about college graduates. The class of 2023 faces a jittery job market, and then someone in the article is quoted as saying, "The world seems to have flipped on its head." Well, the labor market certainly has, David.
And we've been talking about this for a while. We said, look, last fall we talked a bunch about this. That if you were not happy at your job, you were looking to change, it would have been a good time to change because it was still what we call a very tight labor market. You're going to get a decent compensation package most likely, and your skills were viable. And A players are usually employed, so to speak. So someone who's an entrepreneur, when you're looking to hire somebody, you're usually looking to hire from the active workers versus somebody who's been unemployed. Well, and kids were coming out of college the last couple of years and get snapped up pretty quick because a lot of companies just could not fill the roles, and so they hire these college kids, and they were paying above market wages on average 15 to 17%, according to some studies. Basically, so these kids were starting off at higher salaries than their predecessors a few years earlier. And some people were getting upset at that. Well, those are the kids, unfortunately, getting laid off in some of these places today. But now the kids that are about to graduate here this year are not getting the same warm welcome to the job market. And so they're finding it harder to find the career or job that they wanted. And so there's still a decent labor market, but it is quickly changing. And a year from now, it'll be even uglier, I believe. And so I would just tell people, listen, be respectful of your employer, if you enjoy your job, most people do. I think it's human nature. You want to work, you want to provide, but it's a different market. So some of the companies, I will tell you though, are at least encouraging these kids. Hey, look, we'd like to maybe bring you on later. So they've encouraged them to stay in school, maybe go back and get the next level, a graduate degree, MBA or what have you, or PhDs, et cetera. So there are opportunities out there, but depends on your field. Healthcare again is almost always recession proof. And so when clients ask us, "Hey, what should my kid do?" I was like, "Well, what do they like to do first off?" But if they want a recession proof business, healthcare is usually the place to go.
In the financial world right now, it's like Alice in Wonderland in some ways. Down is up, up is down. Don't panic. Come see us, 402-369-7777. Get a complimentary report card. We'll check out your whole financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now is the time to find out. No charge, no obligation. 402-369-7777 for a complimentary report card. 402-369-7777. Up next, as we said last week, the banking industry hasn't wobbled like this since 2008. We take another look at the banking crisis and what it means for you and your retirement. Next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, the banking, you said it's not a slow motion run on the banks. It may be a quiet run on the banks, but there's a bad vibe. There's a bad mojo out there. There's a disturbance in the force when it comes to the banking world.
We're
Now,
seeing well over $100 billion a week exit these banks. $100 billion is outflowing from these banks.
at some point, it starts to sound like the 1930s. I've mentioned this before, the Bailey Savings and Loan, in the It's a Wonderful Life movie. Here's a CNBC headline. Biden calls for stricter banking regulations in the wake of SVB, that's Silicon Valley Bank, of course, and Signature Bank failures. First of all, David, explain to us what the president is proposing And do you like the sound of it, or is it too little too late?
Yeah, it's window dressing from a
We're
political
back to window
standpoint, right?
dressing
Yeah.
again, okay?
It's political cover. Oh, we got to shore up these banks. Well, the banks are shored up, right? And like I said, most small mom and pop smaller banks are absolutely fine because they're conservatively managed. The problem, again, with SVB in particular, Silicon Valley Bank, is they had no risk officer for about 9 months or so, and they were taking an ungodly amount of risk, in my humble opinion, in their reserve portfolio, and that's what caused the collapse. We've talked about this before because people came to the window and said, "Give me my money." As George Bailey said, "Hey, it's not here; it's in Fred's house, right?"
Yeah,
And
yeah.
so the banks don't keep all the money in the vault; they would go broke, right? They have to get that money working back in the economy, and so banks basically profit ship from what's really defined really simply is just what's called net margin spread, right? If you deposit your money in the bank, if I'm the banker, I'm willing to pay you a flat interest rate or a certain interest rate, right? Maybe it's 3%. Then I'm going to turn around and take the money that I have to keep in reserves and keep it in reserves. And that's typically only about 10% or so. But 90% of that money you gave me, I'm going to turn around and loan it to someone else at a higher interest rate. This may be in the form of a credit card, a car payment, a line of credit, a mortgage, whatever it may be. And so that's how I'm going to make money, right? That's called net margin spread. Now they can leverage this, and we're not going to have time to get into all that, but that's how banks make money. They don't actually keep all the money there. And so they're willing to pay you one rate, and they're going to obviously charge somebody else a higher rate and make a spread, right? Well, the problem is if the banks aren't managed well, and the things that they invest in, they can't turn over at a fast enough pace. So, like, while most banks will write a mortgage chip, they don't own or hold the mortgage, they sell it almost immediately, right? So they get that cash back in and then turn it over again, velocity of money. And so that's how they're going to continue to make money. But the problem now is these regulations that Biden is now proposing, if you will, is to just basically limit the loans that some of these banks that are solvent could make. It's going to require higher reserves. It means less loans are going to be made. And whether you agree with it or not, here's what's going to happen, Chip. That means less loans are made to businesses and consumers. That means less economic activity. That means the bank earns less money, which means the value of the bank is going to go
Well, it's gotta go
down.
down. So good actors, as opposed to bad actors, good actors will be punished, penalized under this.
And that's exactly what Frank Dodd did. We talked about this 2,300 page gorilla bill that added 400 such regulations like
Yeah.
this to banks, and some of it was overreach. Certainly, we want to have some form of regulation and basic rules in place, but get rid of the bad actors. Don't get rid of the theater, right? And this is the problem: is they're throwing the baby out with the bathwater, and they're going to harm the consumers that bank at all these banks, especially here in the Midwest, right? We're not on the coast with the elites, et cetera. We're here in the Midwest, hardworking people that just want to go to our local bank or credit union and facilitate transactions, have a checking and savings account. But that is almost becoming impossible to have a free account anymore, right? We talked about Dodd-Frank crushed the idea of having free checking, and this will further push it to make it harder for the people. And over 20% of Americans, Chip, do not have a banking relationship at all, right? And this is going to make it even harder.
Well, my impression from the story is that the Republicans on Capitol Hill are saying no to this, saying, "No, we just the bad actors need to be punished, which we can do under the law right now, but we don't need
But
any
full disclosure, if
overreach."
Republicans were in charge currently, they would be doing the same thing, and their Democrats would be screaming against it. It's political cover, right? And each
Okay.
party would do it. So let's give it fair shake there. But again, it's bad. You're right, and it should not happen. I wish that fundamentally was the Republicans' argument, but I don't think that is at this point. But anyway,
It's just because, "Oh, you say the
yeah,
sky's blue, so I'm saying it's green for
yeah,
now."
yeah, and
Okay.
that's the banner. But in the end, it's going to cost you and I as a consumer more to have a banking relationship.
David, you sent me a story chock full of charts and graphs and data. It's from the Real Investment Advice website, and it's headlined, "A Federal Reserve Pivot is Not Bullish." Now, I did recognize in there, I think I saw some representations of the yield curve that you have talked about numerous times, that when that becomes inverted, the return on bonds, when the short term are making more than the long term, you have a problem. But beyond that, David, you're going to have to sort this out. Tell us what the takeaways are from this in-depth study at Real Investment Advice.
Okay, so when the Fed stops raising rates, right? So what we've been talking about this for a while now, Chip. The Fed pivot, like they're going to stop raising and turn immediately go the other direction. And they have done that, but historically they don't. They usually would do what's called pause, right? It'll be a Fed pause, and we may be in that pause now. Maybe they're done, maybe they're not. Again, this idea that they just added more inflationary issues back to the balance sheet and OPEC, the oil cuts, is going to drive inflation higher. So the Fed may have more work to do, unfortunately. But when they actually do, they kind of signal at their next Fed meeting with their statement that we're on pause for a while, or even if they pivot, that's usually not good news for the equities, even though the talking heads on CNBC and what have you keep saying, like, oh, yeah, it's going to rally because the Fed's done. Well, if you go look at the last 9 times, they're pointed out in this article, right? The drawdowns from that point and moment in time until the market found its trough in that current cycle are pretty consistent. The average was over 27% drawdown, average from that moment. And I keep telling people, like, listen, I don't know. I don't have a great crystal ball. We're not the great prognosticator, et cetera. We are simply going to look at data and tell you the probability of what we see in front of us. And right now, it is lower equity markets incoming. That's what we forecast right now, because exactly from what history tells us. And if you don't learn from it, you are doomed to repeat it.
I need a definition and or an example of drawdown. What do you mean by drawdown?
Okay, so drawdown is basically how far is from this point in time. So when the Fed, let's say the Fed announced today, hey, you know what? We are done definitively on a rate hiking. It's
Okay.
over. So the 9 hikes that have taken place, et cetera, that's the last one is done. So if we were to mark the S&P from that date and then track it and then look forward until the cycle is over. So how far does the market drop percentage-wise from here? That's the drawdown, right? So basically, and there's examples in the article which we'll post on the YouTube channel, et cetera, with the radio show, where it shows you how far this drawdown goes, and the average was 27%. So if the S&P were trading around 4,000 points today, and it was to fall 27% between now and the end of the bear market, that's what we're talking about, drawdown. So because, Chip, and there's an instance in there where it's over 56%, right? If you lose 50% of your money, Chip, your hard invested money, and always like, oh, just stay in there for the long haul, right? That's what we hear cheerleading all the time. You got to stay invested for the long haul. Well, if you lose 50%, how much do you have to make to get back to even? It's not 50%. You'd have to make 100% return the next year just to get to even, wouldn't you?
Because on the pile of money you have left, you have to double that
Correct.
to get back to where you were.
And so managing drawdown and things like sequencer returns are critically important when it comes to retiring your dollars, especially at or near or during your retirement as you're starting to pull dollars out of those. You don't want to be pulling 5-6% out of your accounts when they're down 20 or 30%. The idea that you'll get back to even ever becomes a very low probability. And so we want people to understand this is why you need to have somebody proactively looking at risk management in your portfolio, especially if you're about to start taking income or already taking income from the portfolio.
So absent a proactive strategy, including strategies to mitigate damage in rough times, if I'm just on autopilot and there's a 27% drawdown, my $1 million portfolio is now worth, $750,000 or something. Right?
Correct.
Okay.
And so now to get 750 back to $1 million, you don't have to make 25%. You got to make about 38%, right?
Yeah.
So
Okay.
that's why it's critical to manage the drawdown.
David, you mentioned net margin spread. Now, you also sent me a story from Zero Hedge about junk spreads. Junk spreads show U.S. economy is close to a recession. What is a junk spread, and why is it a herald of woe?
All right, so when they're referencing junk, they're talking about what is called junk bonds, or at least used to be called junk. It's now called high yield. Sounds nicer, right?
Oh, there's some more window dressing.
Yeah.
That's
So
the theme today.
Wall Street changed the name from junk bonds. There was after Michael Milken back in the 80s, the junk
I'm old
bond
enough.
king.
I remember that. Yeah.
So maybe we shouldn't call these junk bonds. Let's come up with a new name. Oh, I got high yield. That sounds really nice, right? I'm gonna get a higher yield on my investment, right?
Yeah.
And that's what it is. So it's poorer credit companies, right? So we all have credit scores, right? So when you go to the bank or try to get a mortgage, right, they're gonna pull your credit report, and if you're up over between 800 and 850, you are basically what's considered like perfect credit. You're gonna get the best interest rate. Well, if your credit score was 500, you may not be able to get the mortgage, or if you are, you're gonna have to pay a higher interest rate because you're a higher risk. It's the same in the corporate world when people in corporations are trying to finance their growth, et cetera, or funding for things. They're going to get financing via bonds, right? Debt. Well, if you're not so well rated, you're in the not investment grade anymore, which used to be called junk, and now we call it high yield. And just there's credit scores for for companies as well. You have AAA, AA, single A, then triple B, double B, single B, then triple C, double C, single C. So those are the main 9 ratings. Once you're below that triple B, so the first 4 are considered investment grade. Those are considered safer clients. So that'd be like your credit score being 720 to 850 in there. Once you're below that line, the Mendoza line, if you want to call it, you're now in the bad credit company. So you're going to have to pay a higher interest rate, Chip. And so the spread, though, from a good interest rate and a bad interest rate, well, in rougher times, we're going to make you pay through the nose, right, for poor credit. So the spread, in other words, if a good company could borrow right now at 6%, a bad company would be borrowing maybe at 9%. That 9 is now moving to 10, but the good company still gets 6. So the spread widened. Do you follow me? The spread between good debt and bad debt widened.
I follow you, and I have the advantage of looking at a couple of charts in this story that show that widening spread.
That widening spread
one
is
chart
a
says
precursor to defaults and in a bad
exactly.
economy.
One of these is headlined "Approaching an Inflection Point." In other words, a triggering point where the bad stuff starts happening
Yep.
because the spread has become too
So
wide.
again, it's a precursor to ugly economic times coming, Chip.
Don't be a victim of any of that. Get a complimentary report card. Find out where you are or where you need to be in these unprecedented times. 402 369 7777. No charge, no obligation, comprehensive review of your financial situation. The report card, 402 369 7777. Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, a bunch of questions today on Social Security. The first one says, I'm 59, planning to retire at 64. What is the maximum benefit a person can collect from Social Security?
Okay, so to understand how to get the maximum benefit, you will not get it at 64. All right. And there's a lot of confusion at the different ages, and there's what's called FRA age, which is basically your full retirement age. This is when you qualify for your normal benefit. You can then enhance that benefit by waiting, and it's called delayed credits, till age 70 currently. And so anybody that's born from basically after 1960, full retirement age is going to be 67. So this person's 64, so they're basically going to be 66 in 10 months. Okay, so their full retirement age. So basically, 'cause they would be born in 1959, right? So basically, what you want to do is understand. We can run the math for you and show you. Now, the max benefit, just so you know, Chip, is in 2023 $4,500, I believe, $55. And the way you achieve that is you have max earnings for 35 consecutive years. In other words, you're the number one factor in how we determine what you earn in Social Security is your top 35 earning years, and you don't want any zeros in there. And a lot of people actually don't work a full 35 years in their working career. And so they're not going to max out that benefit. Now, that is the max benefit currently in 2023 that anyone is collecting. And if you rolled on Social Security last year, you would have had to wait to 70 to have accumulated that the max age.
But that surprises me. That's almost 50 grand a year.
Yeah,
right?
yeah,
That you could
it's
be
actually more than that. Yeah, that's
I
over
thought
50
it was
grand,
gonna
yeah.
be like 30 or 35 grand to be the maximum you
No,
could ever get
well,
from
and
Social
again, a
Security.
lot of people, there's memes always around social media. Oh, average Social Security benefit is $1,200. No, the average Social Security benefit, folks, is over $1,800 now. That's average, okay? And so that's like 22,000 is the average benefit.
Mhm.
And again, a lot of people, almost 40%, make the mistake of drawing Social Security too early, like at 62, 63, et cetera. This individual says they're 59, but going to retire at 64. I will ask that person, have they thought about health care from 64 to 65? That's a big gap and a big number. And you just need to understand if your own workplace, you might want to work one more year in that example. But anyway, yeah. So, and this is why we teach the class, so that people can understand how to maximize the benefit. And a lot of the strategies we used to help people understand how to really maximize or optimize their Social Security would benefit people that were married, because we had some unique strategies that used to be available called restricted application, file and suspend, et cetera. But if you're single, it's pretty simple. Your earnings are the only earnings history we're working on. And if you can afford to wait and you're healthy, you should.
Well, the other questions are in the same vein that we're working here, David. Let's go to the next one. I'm confused about maximum benefits from Social Security. I was born in 1960, which I think means that I qualify for full benefits at age 67. But I have heard you and other financial advisors say I have to wait until age 70 to collect full benefits. Which is it?
Okay, so You are correct. Born in 1960. We just talked about this. Your full retirement age, FR age, is 67. That's when you qualify for your full normal benefit. There is a bonus, a delay, if you wait to draw Social Security. Basically, it amounts to about 8% a year. It's actually two-thirds of 1%, basically, for each month that you wait, right? So basically it comes out to about 8% per year. And so to get that max benefit, 70s as long as you can delay it, and then you're getting a bonus, if you will. So basically that's almost a 30% increase in your net benefit. And so that's a huge deal. And if you're and let's face it, we are living so much longer than people believe. And that's why for most people, especially again, if it's single or married, there's some choices we have to make. We want the highest earner to wait as long as possible, typically, to draw Social Security. Now, there's other factors in there, taxation issues we got to talk about, where we'd pair with Roth conversions, et cetera. But for most people, yeah, you need to understand your full retirement benefit age, your FRA age, is not your maximum benefit. You can delay it to 70 and get a bonus.
So you qualify for the full benefit at 67, but there's a bonus if you wait until 70.
Well, the government
Okay.
doesn't like to spend money, so they're incentivize you. Hey, if you hold off, we'll give you more every month, right?
Okay. Hoping maybe you die in the interim or something so they don't have to pay it off. All right. I didn't mean to sound that cynical. But let's keep rolling here in this same vein, David. The next question says, I'm 68 and receiving Social Security benefits. I heard a friend talk about delayed retirement credits. Well, you just mentioned that, David. It had to do with suspending Social Security benefits, but I didn't understand the advantage in doing that. Can you explain delayed retirement credits and whether it's a strategy I should consider?
You can't. You're 68, and if you've already turned on Social Security and you've had it on for a year, you can't undo it. Okay.
Ah, okay.
There used to be unlimited redos Social Security. That went away a few years back. Okay. We used to go back and change it. You can change your Social Security election within 12 months of making your election. You only have one shot to do it. But if you're 68 and you've already got Social Security turned on from 67, that year's gone. So you're locked in where you are. So you're not going to be able to change it. Now, what they're talking about is delayed credits and suspended are two kind of different things here. So delayed credits is what we talked about just a moment ago from the previous question. Once you get to your FR age, let's say 67, each year you delay it, you're going to get about an 8% increase by delaying taking it. That's the bonus we're going to get. And just so you know, it's actuarial math. The break even is going to come in right around 78 years of age, where you have gotten more money out of Social Security if you live past that age by waiting to 70 versus 67. All right. And then the longer you live, though, the bigger that gap works in your favor. And again, it's just some actuarial math at what you believe your life expectancy to be. Now, the suspend your benefits, there used to be what's called file and suspend, but anyone born in 1960 doesn't get to play that. You had to be born in 1954 or prior for that benefit to be available. That's gone. So we don't really even need to get into that. But that's where we used to file your benefit chip if you were one spouse and suspend it immediately. Then I was your if I were your spouse. Sorry, I did that to you last week too. Right. But then I could go draw my spousal benefits off of your benefit, but you're not drawing yours and delaying yours to get the higher credit. That's no longer available.
All right. Let's squeeze this one in. Only about a minute for this one, David. But can you receive Social Security benefits while still working?
Absolutely. That's pretty easy to answer. The answer is yes.
See, I thought it might have been a no, but it's a yes, you can.
You can. Now there's some caveats though, all right? So if you draw your Social Security prior to, again, FRA age, your equivalent
Full
full retirement
retirement.
age, right?
Okay.
So it's either going to be 66 in some months or 67 for everyone that's not already on there. If you draw it early, like at 62, there's an earnings test. So if you're still working, basically if you draw it early, and in 2023, I believe the number is just over $21,000. So you can earn like $21,240 or give or take a couple dollars, it may be off. Every dollar you earn over that, or every $2 you earn over that, let's just say somebody earns double that. They earn 42,000 or whatever it is, right? And they're working and they turn the Social Security on. For every $2 you earn over that threshold, they're going to take back $1 of your Social Security. So you're going to give up half of everything over that. So in that example, you'd give up 11 grand of your benefit. Plus, you've reduced your benefit by over 30% by turning on early. Is that really a good deal? No. And
That
again,
may
people
not
make
be, yeah.
mistakes and go draw it early all the time. Don't do this without getting educated. Now, I want to make sure there's a limit on the high side. Now, once you get past your full retirement age, you can earn money, right? You can still be working. Like my dad worked well past 70, et cetera. A lot of people want to keep working, but they might want to turn it on at, say, 67. They want to start getting their benefits. They don't believe they'll outlive it, so they want to turn it on. Yes, you can still earn. Now, the threshold there on the high earners, once you're gone past full retirement age, is 56,000 and change. So you could earn 56 grand and no reduction in that benefit, even while you're still working. If you earn over that, for every $3 you earn over that threshold, they're going to take back $1 in Social Security. Again, a little bit complicated. I know it's not as simple as it can be, but we have software. We'll run these analysis for folks anytime they want.
Exactly. This kind of analysis and planning, how to optimize your Social Security benefits, this is part of what goes into the complimentary report card, 402-369-7777. There's no charge, there's no obligation, but this is the kind of analysis and the recommendations that we'll make. 402-369-7777 for a complimentary report card. 402-369-7777. Up next, Wallet Hub published a report on which states have the highest tax burdens. Where did Nebraska rank? We'll tell you next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, this is not a list that you want to be number 40 or number 50 on this list. But anyway, Wallet Hub, 2023's tax burden by state. I'll let you deliver the bad news, David. Where did Nebraska come in on this ranking?
Well, let's start with the good news. We're not we're not in the top 10. Chip.
Okay, good. All right.
Unfortunately, we came in at unlucky number 13.
Yeah,
So we're
yeah.
the 13th worst state for a tax burden, according to this survey. Now,
Well-
there's a lot of factors that go into this.
Well, they're looking at the big three: property tax, income tax, state sales tax, and so forth to come up with a total tax burden. David, when you're right on the heels of California, though, I don't know. That gives me heartburn.
Well, and it does. And the problem, again, is not that we've added a lot of taxes, although there are some people in our local state legislature trying to add some taxes to us locally here.
Yeah.
If you're not paying attention, you might want to call your representative here. But yeah, we just didn't do anything proactive. We had all this federal stimulus money that came out to the states and to the local governments, and some decided to waste it, and some decided to, hey, you know what? We're going to have some extra dollars. Why don't we start cutting taxes? And all of our neighbors, every state that borders Nebraska, went proactive in the last 3 years and reduced the tax burden of their citizens. Here in Nebraska, we did. Now, I can't say we didn't do anything. We've trimmed military pensions from being taxed on state income tax. We are slowly ripping the Band-Aid off on the Social Security tax. We need to just get that done. But we are so far behind our neighbors, and it's costing us economic activity because people are migrating away. I just had someone that came in, and they were debating on staying here or in Texas, where they have some relatives and some adult kids. And, and they just like, we love it here. They live north of town here in a nice community, et cetera. And so the tax burden in their county was a lot better than the one we were in. But anyway, but I just did the brass tax numbers and showed them the numbers as a fiduciary. That's my job, is to kind of show you the data. And it kind of, well, we're going to Texas, Dave. Thanks. I mean, they literally sat on it for 2 days, called us back. We're going to be moving to Texas here in about 2 months, and thank you for the data points. We're losing people, and so and this is somebody who's going to have 6-figure retirement incomes, going to be a bellwether of the community they settle in, and we're losing that person spending money at the grocery store, spending money at the movie theater, spending money at the gas station, spending money on plays and things like that. And if we're going to drive people out, the brain drain we talk about, the young people don't stay because we don't have enough good paying jobs for them, but the seniors walk away. That's hugely important to our economy, because now it helps. If they stayed, that would really boost our housing market. So
Boost the housing market. It's important to the economy. It's important for tax revenue. David, in my days, way back when, in my days as a county commissioner and a state senator, I got calls, emails from people
Senator Michaela Kavanaugh and the Kavanaugh family is a prominent Democratic name here that used to be what I would consider, and from you teaching me the history of this local area, a pretty pragmatic Democratic family. But this current version, I'm sorry, she has zero economic understanding of how things work, and she continues to propose legislation that would just increase taxes on you and I, anyone in the city limits of Omaha, to a greatity. We're talking about tens of millions of dollars in new taxes, and on people that can afford it the least. She's trying to add a half-cent sales tax to your grocery bill, your restaurant bill. That would put us over 10% tax to go out and eat a meal here in Omaha.
Yeah.
That's ludicrous.
Yep. No, Jim Kavanaugh, the previous generation of Kavanaughs, who's on the county board is actually one of the fiscal conservatives in local government, but,
Well, maybe they
the
can have a
next
little family get
generation
together here soon, or
yes,
maybe over Easter they might have a little come together and
the
talk about
next
some things. I don't know.
generation's a little further left. You know, unfortunately, Nebraska did make the top 10 in one aspect of that survey, and this won't surprise anyone. Property tax, we rank the ninth highest burden in the nation. I know that's a pet peeve for you, David.
Yes, it is. And
Yeah.
again, because we put no limits on the entities and their ability to tax us, the local governments or the school boards, and they're just running. I mean, even some what you would think would be fiscally sound ones like Millard is increasing taxes on people, and it's just not good.
David, you mentioned the housing market, and you sent me a story. Uh, the statistics come from Case Shiller, and it's housing stats in various major cities around the country. They're getting walloped. Some of them double-digit decreases in home prices. Now, was this new homes or just homes in general?
This is homes in general. This is the average price of homes, basically, that are actually sold, right? So this is tracking the prices of homes through their data. And so, as you would expect, prices are going backwards in some of the places that they went basically parabolic. So it's not going to be a surprise, at least not to me, that the number one retraction there was San Francisco, right? We've seen, and by the way, my goodness, in San Francisco, um, a young entrepreneur that was well known in San Francisco was just stabbed and killed just the other night. He's the inventor of Cash App. Your kids may use this app. He developed this app. He was literally just stabbed on the street, literally Tuesday night, killed. Ridiculous, because they're just crime is out of control in these cities, and so the jobs are pulling out of high tech areas. We've talked about all the layoffs from the big tech companies the last several months, and San Francisco is the hub of that stuff. So those
Yeah.
prices are now fading fast, down 17%. So imagine, Chip, you signed up for a job, you got out of college, you were a coder or some kind of software engineer, you went out there and you got this great paying job at 200 grand a year, but your house cost $1 million. That, by the way, in San Francisco, that's not even the median price. And it's down
Mm.
17%. That means your house just lost 170,000 in value, and you might have bought it last year. Oh, by the way, you just got laid off.
Yeah.
What
Oh,
so
double
now
whammy.
you can
Yeah.
understand the spiral of economic activity that
Mhm.
unfortunately may be coming from this. And of course, the cities on here, Seattle was right behind it at 16%. New York was at number 15 at only 2%. But that's going. Chicago was number 13 at -4. Now they just had a mayoral election this past week that I think is going to push them to the top of the list here pretty quickly. This They just elected a avowed communist as their mayor, and so it's going to drive more economic activity out. It's kind of interesting to watch what's going on around the world. But here, the bottom line, I know we're talking about some of these periphery stories. People know, hey, look, we're in Omaha. We're okay, right? Well, nationwide, houses are down over 5%. We've been talking about this for a while. 5% nationwide, and that's probably going to go past 10% pretty soon. So here, even in Omaha, where a medium home is just under 300 grand, you go down 10%, that's $40,000. Your house value goes down. If you had to move or had to go, that's less equity you get to pack up on the road with you,
Well,
right?
that's
That's
a
gonna
wallop.
it
Yeah.
is, and that's
Yeah.
that's gonna create a lot of pain points. So be prudent, understand what these things mean for you and your finances.
David, in the final few minutes here, all right, let's push away from the immediate and the pressing and the urgent, and let's look at the timeless and the eternal. It is, after all, Easter weekend. What's the Brooks family doing for Easter this year?
We'll be at church Easter Sunday, and those of you that don't know, I have my dog. Actually, we got 3 years ago on Easter weekend, and his name is
Risen.
Risen. Yeah,
Yeah.
absolutely, and to celebrate the Jesus Christ being risen, from the tomb. And for those of you that are believers, it's an amazing holiday. For those of you who aren't, I hopefully you'll just respect those that choose to believe. But Holy Week, right, this past week, and you've got so many different festivities. Good Friday we just had, etc. I was at the prayer breakfast here in town. That's a great event every year. So I just tell people, look, it's an amazing a day of to look back and reflect. And for those that are religious and those that aren't, by the way, it's the number one day for several restaurant chains in America. They do really
Oh,
well
especially the
on
brunch,
Easter.
I
Yeah.
suppose. Yeah.
So,
Yeah.
but for us, exactly, we'll go to Easter services and then just be spending the Sunday afternoon quietly at home. So, but yeah, Easter is an amazing experience. And again, I was not always the evangelical Christian that maybe I am today, one of the things I always challenge myself is to kind of evangelize a little bit more and tell people openly of my faith. And my dad, I joke about all the time, son, you're in sales. You shouldn't talk about religion or politics, And so, and look, I'm not afraid to tell people that, but once I was, I literally was, I struggled with just being open about it. But Jesus Christ is my Lord and Savior. I have no problem saying that. But I'm also, I'm taught that Jesus loved everybody. And so I love those that don't believe what I believe and have no problem with that. And
Well,
like,
and we work with everybody from all backgrounds here at
oh,
Retire Smart too. I want to make sure
absolutely.
people know that.
But
Yeah.
anyway, just enjoy the weekend. Have a blessed Easter Sunday, and we'll talk to you next time.
Meanwhile, the tax planning guide is there for you if you want it. 402-369-7777. Your taxes need year-round attention. Take advantage of that complimentary tax planning guide. And then, of course, take the plunge. Get the report card. 402-369-7777. No charge, no obligation. 402-369-7777 for a complimentary report card. David, bring us home.
Have a blessed and awesome week, and happy Easter to those of you that participate. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.